If you want to understand what's really happening to money, stop watching stock market headlines. Stop refreshing inflation numbers. Stop arguing about whether the next recession will be soft or hard. Those questions are too small. Because the most dangerous financial changes don't announce themselves with sirens. They happen quietly while people are busy debating the wrong thing. Here's a thought that might feel uncomfortable. Every paper currency in history has failed. Every single one. Not because of bad luck, not because of villains in a movie, but because of how the system itself is built. Most people think currency collapse looks like chaos overnight. Banks shut down, shelves empty, panic everywhere. That's not how it usually starts. It starts with rules changing. Slowly, almost politely. Savings that used to feel safe stop keeping up. Prices rise, but wages don't. Assets move in strange ways that don't make sense anymore. And one day people look back and realize the damage didn't happen all at once. It happened while they were standing in line, trusting numbers on a screen. This isn't about fear, it's about pattern recognition. By the end of this video, you won't just know what has happened before, you'll see what most people miss while it's happening in real time. And once you see it, you can't unsee it. Most people think financial risk shows up in obvious places. They watch the stock market, they watch unemployment numbers, they watch the Fed and wait for the next rate cut or hike. That's where the media tells them to look. But historically, the real danger doesn't start in markets. It starts in structure. When a system is healthy, small shocks don't matter much. Prices move, then stabilize. Debt grows, then shrinks. The rules stay consistent. People can plan. When a system is unhealthy, the rules quietly change to keep the system alive. Governments spend more than they collect, not once, but structurally. Debt stops being temporary and becomes permanent. Printing money shifts from emergency tool to routine policy. None of this looks dramatic in the moment. In fact, it often looks responsible, necessary, even compassionate. That's why most people miss it. Mainstream narratives focus on symptoms. Inflation this year, growth next quarter, elections, personalities. But currency failures don't come from one bad decision. They come from long-term incentives baked into the system. Once those incentives are locked in, outcomes become less about politics and more about math. And here's the key mistake. People assume modern systems are different, more advanced, more controlled, more immune. History says otherwise. Technology changes, institutions change, human behavior doesn't. When trust in money erodes, people don't wait for permission. They adapt, quietly, rationally, individually. And by the time the shift is obvious, the protection window has already closed. To understand what's coming, or what might come, you have to stop asking, what's the news today? And start asking, what incentives are being created and where do they lead over time? That's the lens we're going to use. Let's step away from opinions and look at what actually happened, with dates, numbers, and documented outcomes. In Germany after World War I, the Weimar government financed war reparations and domestic spending largely through money creation. In mid-1922, the exchange rate was roughly 320 marks per US dollar. By January 1923, it had collapsed to 17,000 per dollar. By November 1923, the rate reached 4.2 trillion marks per dollar. Prices didn't rise annually or monthly. They rose hourly. Wages were paid twice a day. Savings accounts were wiped out. In Zimbabwe, chronic government deficits and land seizures led to rapid monetary expansion. By 2008, inflation was officially estimated at 231 million%, though independent estimates ran far higher. The government issued a 100 trillion Zimbabwe dollar note, which could not reliably buy a bus ticket. The currency was abandoned entirely in 2009. In Venezuela, inflation accelerated after 2013 as oil revenues collapsed and monetary financing increased. The bolivar went from 10 per dollar in 2010 to over 1 million per dollar within a decade. Between 2014 and 2021, cumulative inflation exceeded 1 million%. Cash became functionally useless for savings. Lebanon presents a more recent and instructive case. For over 20 years, the Lebanese pound was pegged at 1,507 per dollar. In 2019, capital controls were imposed. By 2021, the black market rate exceeded 14,000 per dollar. By 2023 to 2024, it approached 90,000 per dollar. Depositors with local currency savings lost over 95% of their purchasing power, even though their account balances barely changed numerically. Across these cases, several common data points repeat. Government spending persistently exceeded revenue. Central banks financed deficits. Currency supply expanded faster than economic output. Purchasing power declined rapidly. People shifted away from domestic currency before official collapse. Importantly, these were not isolated or culturally unique failures. Similar dynamics appeared in Argentina multiple times, Brazil in the 1980s, Russia in the 1990s, and parts of Eastern Europe after the Soviet collapse. The timeline differs, the politics differ, the language differs, but the numbers tell the same story. Once a currency enters sustained debasement, reversal is rare without external restructuring, default, or replacement. The data doesn't show cycles, it shows endpoints. These are not predictions, they are documented outcomes. When you line these events up side by side, a pattern starts to emerge, not just economically, but strategically. One possible interpretation is that currency collapse is rarely a sudden accident. It is more often the final phase of a system that has been optimizing for short-term stability at the expense of long-term credibility. When governments face structural deficits, they have three broad options: raise taxes, cut spending, or finance the gap indirectly through monetary expansion. Historically, the third option tends to be the least politically painful in the short run. The costs are delayed, diffused, and difficult to trace back to a single decision-maker. This suggests that inflation and currency debasement may function as a form of implicit taxation. Instead of collecting money directly, the system reduces the purchasing power of existing money. Those holding cash or fixed claims absorb the loss. Those closer to asset ownership or political leverage are often insulated. Another strategic implication involves timing. In most historical cases, early signals appeared years before full collapse. Capital controls, dual exchange rates, and informal dollarization tended to emerge well before official failure. These measures may indicate that authorities are attempting to slow capital flight rather than address underlying imbalances. Who benefits during this phase? Entities with access to real assets, land, commodities, productive businesses often retain relative value. Exporters earning foreign currency may see improved margins as domestic costs fall in real terms. Governments temporarily benefit from inflated nominal revenues even as real capacity deteriorates. Who loses? Households relying on wages paid in local currency, retirees living on fixed incomes, and savers holding domestic bank deposits tend to bear the brunt. Their losses are gradual, which reduces resistance, but cumulative, which makes recovery difficult. Another strategic dimension is trust. Money functions less as a physical object and more as a social agreement. Once trust begins to erode, behavior changes in advance of official policy. People shorten time horizons, they spend faster, they convert value into alternative forms. These behavioral shifts can accelerate the very outcomes authorities are trying to avoid. From a systems perspective, this creates a feedback loop. Debasement reduces trust. Reduced trust increases velocity. Higher velocity intensifies inflationary pressure. This may help explain why stabilization efforts often fail once credibility is lost. At that stage, technical fixes matter less than belief restoration, which is historically hard to achieve without a reset. The strategic lesson isn't that collapse is inevitable in every case. It's that once certain thresholds are crossed, outcomes become constrained. The system starts selecting from a narrow set of endings rather than an open field of possibilities. Once currency credibility weakens, the effects don't stay confined to prices or exchange rates. They propagate outward through the entire system. Financial markets are usually the first to distort. Asset prices begin rising in nominal terms, not because real value is increasing, but because the unit of measurement is shrinking. Stock indices may hit record highs, while real purchasing power stagnates or declines. This creates confusion, especially for households relying on traditional benchmarks to judge economic health. Banks face a different kind of stress. When deposits lose real value, savers look for exits. Capital controls, withdrawal limits, and forced conversions often follow, not as a cause of crisis, but as a response to it. At that point, banks shift from being custodians of trust to instruments of containment. Credit allocation becomes politicized, and balance sheets deteriorate quietly. Currency instability also changes government behavior. As borrowing in stable foreign currency becomes more expensive or unavailable, states rely more heavily on domestic financing. This increases pressure on central banks to accommodate fiscal needs, further blurring the line between monetary policy and budgetary survival. On a broader scale, currency stress reshapes global relationships. Countries experiencing persistent debasement lose leverage in trade negotiations and capital markets. Import dependence becomes a vulnerability. Strategic resources are repriced in foreign currency, and supply chains become harder to maintain. At the same time, capital becomes more selective. Investors prioritize jurisdictions with predictable rules, enforceable property rights, and credible monetary frameworks. This can deepen inequality between regions, not because of productivity alone, but because of perceived reliability. One often overlooked consequence is social. When money stops functioning as a stable store of value, long-term planning erodes. Saving feels pointless. Contracts feel fragile. Trust shifts from institutions to networks, family, community, informal arrangements. Economic behavior becomes defensive rather than constructive. Over time, these pressures can alter political incentives. Populations experiencing sustained loss of purchasing power become more receptive to radical solutions, price controls, or nationalization. History shows that such responses may provide temporary relief while weakening institutional capacity further. Taken together, currency debasement doesn't just distort an economy, it reorganizes it. Markets adapt, governments react, households adjust. The system doesn't collapse in one moment. It reconfigures, often in ways that are hard to reverse. All of this can sound abstract until it shows up in everyday life. So let's translate the macro picture into things that actually matter to you. Start with savings. Most Americans are taught that being responsible means keeping money in a bank account, contributing to a 401k, and holding safe assets like bonds. That works well in a stable monetary environment. It works far less well when purchasing power erodes over time. When inflation runs ahead of wages, your savings don't disappear overnight, but they quietly lose future buying power. The number on the screen stays the same. What it can buy changes. Next is cost of living. When currency weakens, essentials tend to reprice first. Food, energy, housing, insurance. These aren't optional expenses. Even modest inflation compounds quickly when it hits things you can't substitute away from. That's why people often feel poorer, even when official statistics suggest things are manageable. Jobs are affected too, but unevenly. Workers paid in fixed salaries or hourly wages feel pressure early. Employers facing rising input costs and uncertain demand become cautious. Hiring slows. Raises lag. Meanwhile, roles tied to hard assets, exports, or pricing power tend to adjust faster. The labor market doesn't break evenly, it stretches. Investments behave in ways that can feel counterintuitive. You may see markets rising while your lifestyle feels tighter. That disconnect can create false confidence or unnecessary panic, depending on how you interpret it. Without understanding the difference between nominal gains and real outcomes, it's easy to make poor decisions at the wrong time. And then there's family planning. Long-term goals, buying a home, funding education, retirement, depend on stability. When money becomes less reliable as a measuring stick, planning horizons shorten. People delay commitments. They become more cautious or more speculative, often swinging between the two. None of this requires collapse to matter. Even partial erosion changes behavior. The key takeaway isn't fear, it's awareness. Understanding how macro shifts translate into daily pressure gives you a chance to respond deliberately instead of reactively. And that difference between reacting and positioning is where resilience usually begins. At this point, I want to give you something more useful than facts or predictions. I want to give you a way of thinking. I call this the structural resilience lens. Instead of asking, what's going to happen next? This lens asks, what still functions if the system changes? It's a shift from forecasting events to evaluating durability. Here's how it works. First, separate money from value. Money is a tool, a measuring unit. Value is the underlying utility, food, energy, shelter, productive capacity, skills, and access. When systems are stable, money tracks value closely. When systems distort, that link weakens. Second, identify dependency chains. Ask what your income, savings, and lifestyle depend on. Are they tied to a single currency, a single employer, a single system continuing to work exactly as it does today? The more concentrated the dependency, the more fragile the outcome. Third, observe incentives, not promises. Governments, institutions, and markets respond to incentives under pressure, not stated intentions. When survival becomes the priority, rules tend to bend. Understanding this helps you anticipate behavior without assuming malice or incompetence. Fourth, prioritize optionality. Resilience doesn't mean predicting collapse. It means maintaining the ability to adapt across multiple scenarios. Liquidity, mobility, diversified exposure, and transferable skills all increase optionality. Finally, distinguish between volatility and risk. Volatility is uncomfortable but temporary. Structural risk is quiet and cumulative. The structural resilience lens trains you to focus on what compounds damage over time, not what dominates headlines today. This framework isn't about fear, it's about clarity. Once you start viewing financial systems this way, you stop reacting emotionally to every data release. You begin asking better questions, and better questions usually lead to better decisions, regardless of how the macro picture evolves. This is where everything we've talked about becomes actionable, not in the sense of telling you what to buy or sell, but in how you position your thinking. Start by shifting from optimization to resilience. Most financial advice is about maximizing returns under one assumed future. Resilient thinking accepts uncertainty and prepares for multiple outcomes. Ask yourself, if conditions change, do I still have options? Next, diversify by function, not just by label. Two assets can look different on paper and still fail for the same reason. A savings account and a bond fund may both depend on one currency holding its value. A diversified portfolio should include assets that respond differently to stress, some that benefit from inflation, some that preserve purchasing power, and some that generate real economic output. Pay attention to currency exposure, even if you never trade currencies. Your income, savings, and expenses are all implicitly denominated in something. Understanding which currency or system you're actually dependent on helps you see risks that don't show up on account statements. Observe behavioral signals, not just official data. When people start preferring hard assets, foreign currencies, or tangible goods, not out of speculation, but out of habit, that's information. When rules change quietly, such as withdrawal limits or new reporting requirements, that's information too. These signals often appear before headlines catch up. Reduce fragility in everyday life. This doesn't mean hoarding or panic. It means maintaining buffers. Liquidity, skills that transfer across industries. Lower fixed expenses where possible. Flexibility in where and how you earn. Finally, stay skeptical of extremes. Total confidence and total fear are both costly. Systems rarely collapse exactly on schedule, and they rarely remain stable forever. The middle ground, prepared but calm, is where most long-term success lives. Practical resilience isn't about predicting disaster. It's about not needing a perfect forecast to be okay. If you can adapt to multiple futures, you don't have to guess which one arrives. If there's one idea to carry with you after this video, it's this. Most financial damage doesn't come from sudden collapse. It comes from staying aligned with a system long after it stops rewarding the behavior it taught you. History doesn't repeat because people are careless. It repeats because systems create incentives, and people respond rationally to those incentives until the rules change. Currency stability isn't a guarantee. It's a condition, and conditions evolve. That doesn't mean panic. It doesn't mean abandoning institutions or preparing for the end of the world. It means recognizing that money is a tool, not a promise. When you understand that, your focus shifts from chasing returns to protecting purchasing power, from reacting to headlines to observing structures, from hoping the system stays perfect to ensuring you're adaptable if it doesn't. The people who navigate periods of monetary stress best aren't the loudest or the most extreme. They're the ones who stay curious, flexible, and grounded in reality. History leaves clues, not to scare us, but to prepare us. Once you start looking at money through that lens, you stop asking, what's going to happen next? And start asking a far better question. What still works if the rules change? That's where real financial confidence begins.